I'm Steve Hoven with Delegate CFO. Today, we're going to go over the topic, how much money should a business have in their bank account? Stay tuned. Okay, today we're going to talk about money. Hopefully by the end of this video you find the information helpful. If you do, hit the thumbs up, subscribe to our YouTube channel, follow us on social media for more information content regarding CFO services by us here at Delegate CFO. Okay, so how much money should a business have in their bank account? Or put differently, how much access to liquidity should a business have? Well, it depends. However, we're going to give you the guardrails to be able to make that determination. So, first and foremost, the general rule for the guidelines is a business should have between 10% and 30% of annualized revenue in their bank account. If you do the math, that equates to about 2 to 4 months of expenses within your bank account. Or put differently, if you didn't have any sales, you'd have enough cash to cover 2 to 4 months. So how much cash does your business need? Well, we're going to go through these guardrails and help you make the determination. First, let's go through the mathematics. Now, when we talk about annualized revenue, we're talking about 12 months revenue. So, from a simplistic standpoint, let's do the 10%. So, annualized revenue times 10% should be what you have in your cash reserve or access to liquidity. So, for simplicity, let's assume that you have $3.5 million in sales for your company times 10%. You should have $350,000 in the bank or access to liquidity for your respective reserve. Now, let's dive into the first guardrail, the 10%. And let's go through the basic criteria to make this determination. So, if your business has high recurring revenue, in other words, you're churning products out the door, low days in accounts receivable, obviously that's kind of a given if you're collecting your accounts receivable very quickly, strong sales pipeline, in other words, you've got a very strong pipeline, and then a lot of times this is also called your backlog. You've got one owner for the business, you have high personal liquidity from the owner, and you don't have any concentrations in your customer's revenue. In other words, no customer makes up more than 10% of total revenue for the year. Now, if you look at all these data points of rapid turnover of sales, rapid collections, a backlog of customers, no concentration in revenue, these factors show that a business can replenish their cash reserves quickly. So there isn't a need really to have a large cash reserve. However, one item on here that doesn't really relate to liquidity or sales is the owner's liquidity. If the owner has a high personal liquidity, then if the business gets into a bind, usually the owner will personally fund that difference. Sometimes, we jokingly call this the bank of the personal owner's name. So in other words, the bank of John or the bank of Susan, whatever that case may be. Now, let's dive into the second guardrail, the 30%. And as you probably could surmise, a lot of these criteria are the exact opposite of the 10% criteria. So, in the 30% criteria, if your business has low recurring revenue, high days in accounts receivable, in other words, you're not collecting your accounts receivable as quickly, you have weak sales pipeline or a weak backlog, you have high growth, you've got multiple owners, you have owners with low personal liquidity, and you have high revenue concentration. In other words, you have a customer who is greater than 10% of the respective revenue, or multiple customers of that matter. As you can see, these are indications of slow cash collections. However, the two biggest ones that businesses sometimes don't realize are high growth and high revenue concentration. On the high revenue concentration, that can have a significant impact because if you have one customer that is slow to pay, and if they're greater than 10% of your revenue, that could hold up any future expansion, inventory purchases, hiring, etc. That one customer can hold that up. Now, the one that always sneaks up on businesses is high growth. In times of high growth, there's that euphoric atmosphere within the business because you have many sales, but because of that, you have to buy more and more inventory or hire more employees to be able to keep the sales going out. Now, those purchases, for the inventory is cash out the door. But the respective accounts receivable is not getting collected as quickly as the cash out for the purchases. So high growth, keep in mind, is not just limited to new businesses. Now, that is where it tends to hit the most, but it's not limited to new businesses. It can easily happen to established business. For example, I have seen an established business go from $900,000 of revenue per month to $1.3 million per month. This significant jump caused them to have a temporary cash shortage because, again, they had to keep buying inventory to be able to send it out the door, but they weren't collecting the receivables as quickly as they had to do the purchase the respective inventory. So that does, play into the respective cash reserve aspect. So where does your business fall? Well, use these two guidelines, the 10% and 30%, and again, use these as guardrails. So go through each of those respective criteria to kind of make that determination, where should your business be sitting at. Now, the 4 key parts that I always tell our clients is, first, do you have a concentration in revenue with your respective clients? That can have a significant impact if that particular customer is slow in paying or doesn't pay. Second, the pipeline. How big or good is your sales pipeline or your backlog? Do you need to get the salesman out there? Do you need to do more advertising? Again, that can have a big impact down the road of what your pipeline is sitting at. Third, growth. Are you experiencing high growth? If you're an established business and all of a sudden you see the sales go up, you've got to keep that in mind because that's going to impact your reserves very quickly than what you're used to. And of course, does the owner have a high personal liquidity? Again, that is kind of one of the bigger factors is, can you pull from the owner if you run into a cash shortage? Now, keep in mind, 10% and 30% are just the guardrails. Go through each of those lists and say, okay, I have many of these items on the 10%, but I have high growth. Well, then maybe you want to be at 15% versus 10 or 30%. But again, use those as their guardrails. You don't have to be right at each of them, but they kind of give you an idea as to where you need to be and how much cash your business should have in the bank. I'm Steve Hovland. Hope you found this information helpful, and I look forward to seeing you on the next episode. Thank you.